Hi, and welcome to Specialist Lending Solutions' first lunchtime learning sessions in association with Pepper Money. I'm Shakina Tawahene, Commercial Editor at Specialist Lending Solutions. Today, we'll be discussing the advantages of choosing a second charge mortgage for your client, especially when the desire for a speedy and easygoing transaction takes prevalence. I'm joined by Caroline Mirakian, Sales Director of Second Charge Mortgages at Pepper Money, Matthew Batt, Business Development Manager at Pepper Money, and Paul Zammit, Intermediary Operations Manager at the Loans Engine. Thank you all for your time today. Before I hand over to Caroline, just a reminder that there is the opportunity to ask our presenters questions throughout the session. You can find a text box on your screen to do so, so don't forget to put your questions in there. Now I'll hand over to Caroline. Thank you.
Okay, so the purpose of today is obviously to give you guys an overview of an area of second charges, which is a product which doesn't get talked about very much, but I think given the market, it is certainly a solution that more brokers should look to entertain. So if we move on to the next slide, I'll cover off the agenda for today. So it is just simply having this as an additional toolkit. So it's about giving seconds a second thought. So the objectives for today is to talk about the recent growth and the increased use of second charge lending, and particularly this year as we're bridging the gap to reach £1.7 billion in lending. So how has second charges kind of grown, and how could it be a key armory for an advisor in 2022 and beyond is the purpose of today. And then looking at some myths surrounding seconds, because seconds has had a few misconceptions put around it, and therefore we hope to kind of bust those. Some clear and easy packaging tips to make sure that the case gets completed very smoothly and very quickly. Your typical customer that you may come across for a second, so where a second may be more suitable than a first, and then more importantly, how to access those products. So now what I'm going to do is I'm going to pass over to Matthew Batt and Paul Zammit, who'll be able to walk you through this presentation.
Thank you very much, Caroline. So hello, everybody. If you could just hop on to the next slide, please. Great stuff. So yeah, so first of all, we're going to jump into the market and its historic misconceptions, as it says on the screen there. I mean, prior to MCD, we were looking at a relatively small, flat market. There were large fees, and I'm sure a lot of you on the call today, if you have had any dealings with second charges in the past, that's one of the things that you would often, come to mind straight away, is that there are large fees involved. Complicated early repayment charges as well, where customers have really been penalised with when they've actually come to settle those deals. Obviously, it was prior to MCD. There was, it was poorly regulated at that point, or poorer regulation, and as well, seconds were more expensive than they are now. I think some of the rates that we've seen, certainly at the start of this year, have been some of the cheapest rates that we've ever seen in second charges. And also the journey as well. It used to be a very slow, painful journey as well, with an awful lot of documentations and additional requests from lenders as well. So yeah, just hop on to the next one, please.
I was just saying, Matt, we could talk for hours and hours about the good old days and stuff. I think the reality is that, second charges, they weren't really, they weren't really pushed, were they, in the intermediary market many years ago? Because I think because of the reasons why, the large fees, ERCs and so forth. Whereas now, yes, the reality is that the products are, I think we all understand second charges are stopgaps to a degree, aren't they? They're there to service the client due to, and again, we'll go into the detail along with the rest of the slides, but they're there to service a client where currently unable maybe to access the high street for further advance, or yes, maybe a remortgage and so forth due to ERCs and so forth. But the products now are so user friendly in the sense that a lot of them come without ERCs, for example.
That's right, because it was just looked at as a last resort, wasn't it, previously?
Yeah.
A very last resort, scraping the barrel, so to speak.
Yeah. Yeah, certainly on the ERCs, you know, the old rule of 78, as we used to call it, which was essentially 6 months worth of payments. You know, those days are well and truly behind us, aren't they? Is the truth.
Yes, no, absolutely. And, you know, we've seen the market grow year on year. I mean, Caroline mentioned about the growth. Of course, you know, the elephant in the room, COVID, yes. So things did take a little bit of a dip during COVID, but we're already, I mean, the reality, as you can see on the top there, the market is on track to be a £1.7 billion market in 2022. Now that we were, prior to COVID, we were around about the 1.2. So we've seen some considerable increases there. And we've also been helped, as we'll probably talk about, Paul, I'm sure, is, you know, that's helped by the fact that, you know, we've seen increasing rates on the first charge side earlier this year, cost of living increases. Yes, absolutely. So going back on what I said on the previous slide, obviously now second charges are, you know, they are a regulated mortgage product. You know, they're aligned to NCOB, MMR, MCD. Ultimately, what we're looking for here is the best customer outcome. And if that's to leave the first charge in place because you're on a lifetime tracker, or whatever it might be, on an interest-only first charge, or you just simply can't get enough funds because there's debt consolidation or high LTVs. We're just looking at the best customer outcomes. Now, the way in which mortgages, so with a second charge, obviously you'll be provided with an ESIS, a mortgage illustration. You'll be very, very familiar with them because they are identical to that of the first charge mortgages. Nice and transparent, clear with ERCs if they do apply, clear with every single bit of information that you would expect and that you've come to used to with dealing with first charges. Now, a good thing about what I always tend to talk about, especially at Pepper, is the speed as well. So historically before, you know, it was a very slow, painful process. Now, I'm sure when you speak to all lenders, they always say that they are great at what they do, but we genuinely have a very, very slick and easy process. Ultimately, I mean, you'll know if you have dealt with seconds before, there are a few other things that you need to get over and above what you would normally have on a first charge, and that's maybe a letter of consent from the first charge company or evaluation. Now, you don't always have to have those, especially with ourselves. So we have a home track built into our portal. So when you actually dip a case, you'll know whether or not that actually needs evaluation at that point. Now, if you also don't need consents from the first charge, when we have that deal presented to us and submitted to us, we can actually make an offer on that within 24 hours. And we regularly see that week in, week out. So if speed is of the essence, then, you know, second charges are great, absolutely great for that, and especially with Pepper.
I think that's one of the biggest misconceptions, Matt. You know, is oh, but you're going to need this, you're going to need that. I think the truth is, and especially with you guys, Pepper, obviously, is that, you know, a lot of it is inbuilt with the system. Apart from identifying if consent's needed, but that's simple. You just, obviously, there's a land registry you can access. But in terms of the valuation, your system, you know, tells whoever's using it if you need evaluation or not. You know, and it's just things like that. You don't have to log into a separate portal, for example, which, you know, you do with some other lenders. In fact, most other lenders. But with you guys, as you say, you know, I can truly testify to the fact that, you know, we had a case came in. When was it? Wednesday last week. I think the deeds arrived this morning. You know, so it's just, and of course that includes the weekend. It's just it's that simple, isn't it? You know, especially if you don't need consent, as you said.
It's a shame that you don't see more of those Halifax no restrictions on land registry.
Yeah, that's it. Yeah, no valuation. Yeah, employed 2 pay slips. Job done. Simple as that. Yeah,
absolutely.
That's utopia. That's it. Second charge utopia. Yeah.
Isn't it just? And also the fees involved as well. So lender fees are significantly reduced as well. So lender fees in the second charge world are pretty much in line with that in first charges. Obviously, a lot of people wouldn't think twice if there was a £1,000 fee on a first charge. You know, most of the time people would just click to add that to the loan. That's certainly what I did when I did a PT with NatWest earlier in the year. It made more sense. It was cheaper, more cost effective to go for the one with a £1,000 fee on it. We also have a range of different products available. So, you know, the fixed products. So that's a 2-year fix, 3, 4, 5-year fixes. Now, sometimes they do have ERCs. We do have a 5-year fixed product that doesn't have an ERC, which is very popular. We have a variable rate. We have discounted rates as well. So if you were only looking to have it for, you know, a short term, so a loan for only 24 months, then we can look at discounted 24-month products. And we also have a little hybrid of an interest-only product, which is interest-only for the first 5 years and then switches to capital repayment. And the great thing with that is that it can often help affordability-wise, because it's a 5-year interest-only product. It means that we're not stress testing that second charge payment.
I was just going to say that, Matt, actually, you know, for us, you just mentioned the most popular products probably is the 5-year no ERC, again, alleviating on the stress, and the fact that, you know, again, coming back to one of my first points, which was second charge being a stopgap, it just means that, you know, whether it's 18 months, 2 years down the line, the intermediary can, you know, remortgage out onto maybe something better on the first charge, you know? Yeah,
absolutely. And everyone's looking at those 5 years now, aren't they? Just because of everyone's aware of interest rates going up. You know, it's on the news all the time. So I think you've probably got a lot of customers coming to you saying, "I'm concerned about the rate increases. What can I do to protect myself?" And so we also do loans from £5,000 to £1 million. So you know, I think our average loan will sit around the £60,000 mark, I believe. So so a lot considerably smaller than £1 million, but you know those cases are out there. But yeah, we will go up to £1 million. And the big thing on this page is that we go up to 100% loan to value. Now, I wouldn't want people to panic thinking. You said about the crazy days with the high LTV lending. You know, when people did 120%. I mean, the vast majority of our loans are home improvements or debt consolidation. Now, the home improvements bit, you know, you could be doing a second charge up to 100% loan to value for home improvements. It could be a rear extension just to make a nice big kitchen diner, and it could be to go up into the roof to have an ensuite bedroom up in the loft. So obviously increasing the value of the property. Now, let's say you have that for 3 years. When you come up to remortgage that property, then obviously it's 3 years down the line, so you would hope that the property would be worth a little bit more. But don't forget, it's now a bigger property. It's got an extra bedroom with building regulations. So it's now classed as a 4-bed, not a 3-bed. So the property value has gone up because of that as well. So when you're remortgaging it away, you might actually only be remortgaging it at 80% or 85%, where there is a lot more products available. So don't be too concerned about the high LTV, because sometimes, you know, that's a great example of when high LTV products can really work. Digital journey as well. We've already mentioned the automated valuations, the fact that you can go through our system and get a dip on it within, well, Paul, you're probably better suited to answer that question, but I'm sure you could probably do it within 40 seconds.
Oh, yeah, absolutely. Yeah. And again, it's all laid out for you. That's the thing, you know, it's so simple using the portal.
And, you know, if someone passes electronic EID on Equifax, then great. Then there's no you know, additional ID checks required and things like that. And the next point, no legals. And this comes up always, because I know as a first charge broker, you'd be used to dealing with the conveyancers and pulling your hair out with conveyancers. There are absolutely, you know, I say no legals. There are, you know, there's an element of legals because we need to register our charge on land registry, but we have in-house solicitors who do that. And that's the only thing.
Most common question we have, Matt.
Yeah.
Most common question. Yeah, absolutely. So what about separate legals? No, it's all baked in the price, your fee essentially. It's something you deal with at the back end. It's something that we, as a broker, master broker, packager, need to get involved with. Likewise, for anyone, you know, coming direct, etc. There's nothing that you need to do on that side of things, which is, a very different world.
And as you said, it's back end, exactly. So it's done, you know, it's done when the client's got their money, they've gone on their merry way, and it's only at that point then will our solicitors register the charge. Obviously, if there's a second charge, or if it's a help to buy or whatever it is, and we're redeeming another charge that's on the land registry, that's all done back end, and there's you know, you don't ever need to get involved with it. Yeah. I don't know if there's anything else you want to mention on that slide there.
Not really. I guess, you know, I come back to it's you know, especially for us, obviously, where we're a whole market master broker, you know, don't get me wrong, you know, lenders have certainly improved in terms of their portals and whatnot. However, one thing I would touch on, which is sometimes we take for granted, is the fact that no matter what the market is like with Pepper, their SLAs rarely change. You know, even, you know, okay, postal strikes aside and so forth, but you know, the truth is that, you know, if I was to dip a case in now, let's just say, and we're talking approaching 1 o'clock, I'd have an update by the end of the day. And there's also every chance that we could even get the offer out same day. And I guess in comparison, I mean, when you're looking at, you know, say, a purchase, of course, or a remortgage, sometimes it might not then actually complete until maybe 2-3 weeks. Of course, if it's a purchase of, you know, months down the line. But the reality is, like the example I gave earlier, you know, we can complete within 5 working days. The truth in most cases.
Full disclosure here, I didn't ask it. I didn't ask Paul to comment on
payment checks in the post, Matt.
No, it is nice because there is no, we don't publish an SLA, so it is not. No. You know, we don't do that because we don't need to, because we will pick up that deal if it's submitted to us by mid-afternoon. We'll pick that deal up, and 9 times out of 10 it's worked before close of play that same day.
Yeah.
Okay, so we'll jump on to the next slide, please. Okay, so we've obviously mentioned a couple of these already, but we'll just go through a couple of the scenarios where second charge is more suitable than that of a remortgage or further advance. Now we've spoken about the first one there, which is speed, so I won't go through that again. I briefly touched on lifetime trackers. You know, those deals, even now with the interest increases that we've seen, those deals are still too good to. They're still too good to leave. You know, the GE Moneys, the Cheltenham and Gloucesters, lifetime trackers, they are absolutely gold dust. The interest only switch to a capital repayment could be too costly. The income and affordability there might not stack up. Now, of course, if you've got a further advance facility with the first charge, I'm assuming that would be your first point of call anyway, because that would probably be the cheapest route. But if that isn't an option for whatever reason, it could be high LTV, it could be too much consolidation, you know, because one thing I should have mentioned, so our loans, we can do £100,000 loan and it can all be for consolidation. So we don't, and that's a question I often get as well, you know, what is the maximum amount of consolidation you can do? Well, we don't have one of those. So if you are struggling with a remortgage because of the debt that's outstanding, you know, if that's consolidated with a second charge and, you know, you come to do a remortgage in 2, 3, 4 years, whatever it is, that you're wrapping that up into a new first charge, and it's not unsecured debt anymore, so it's not classed as consolidation.
Yeah, we see that a lot. You know, we've seen a lot of clients where it may be sort of 6 to 8 months ago, Matt, that are coming through again via intermediaries at the moment, where, you know, typically a further advance, you know, just would have gone through, you know, wouldn't touch the side, so to speak. Whereas, you know, I had a case in the other day where, you know, really good high earners, they were looking to clear debt just as a result of recent home improvements. But, you know, the old indebtedness rule was chucked in by the lender. I'm not going to mention the lender, but, you know, well-known high street name. And I couldn't believe it. You know, it was just like they were looking to clear 100K as a set of debt. And they said, no, due to the indebtedness rule, we're going to lend 50. You know, my first go-to was, well, why don't you take the 50 and then we'll do the extra 50? I said, you know what, the amount of cases I've had thrown back at me, I just, you know, it's just not worth it for the client. They've already been, you know, kicked back. They don't want to do it a second time. Can you take it on? And, you know, for us, it was a dream case, you know. It's just another result of just tightening belts.
Absolutely. And if applicants do come to you and they're wanting loans for an unusual purpose, that might be a tax bill. Obviously, I mentioned the debt consolidation. It could even be a business loan. So I'm not saying that we would. Those kind of things do need to be, you know, referred into us, and we're not really going to be doing a business startup. But if you've got an existing business and you're just looking to, you know, expand, whether or not that's buy more machinery or buy new premises to trade from, you know, these are the kind of things that, you know, standard first charge lenders could take issues with. So, you know, again, you'd come to us for a second charge. The ERC's point, I think that's a nice easy one that we would all understand. If there's an ERC on the first charge, obviously a second charge it could potentially be a better option. The affordability, obviously, I guess COVID is still having a little bit of an impact here. You know, if you've got somebody that's changed, you know, circumstances have changed because, you know, maybe they were made redundant during COVID, and then they've been looking to start up a new business, so now they're self-employed and they've only got 1 year's worth of trading, then, you know, those kind of situations we would look at as well. The same goes with maybe credit issues as well. Now, you know, COVID has impacted us all. If you did have applicants that were made redundant and you know, maybe they didn't have a bit of savings behind them and had struggled with a couple of credit cards and loans, missing payments, you know, again, that might not then, it might not be worthwhile then moving them from a high street lender, because you'd have to look at the more specialist market. So, you know, short term, you could look at then a second charge to bring them back up to date. Salary, the LTIs, sorry, I just tripped up them, salary multiple limits. So LTIs, loan to income, we go up to 6 times. And we also have a product. So we have 2 products. Our main product goes up to 6 times LTI. And then we have another product that actually doesn't have an LTI restriction. So if you are struggling with loan to income, again, a second charge is a really good option. You know, all we're really looking at there, of course, it's got to be affordable. So we're just looking at the income and expenditure then and making sure that it passes our affordability.
Just on affordability, Matt, as well, one thing that you guys offer is the sole proprietor joint borrower situation, you know, where, for example, mortgage is just in that one person's name as is the title, but they have, you know, a partner, a long-term partner, wife, spouse, husband, even sometimes, you know, a child that lives in the property, an older child where, you know, they might not be still on the first or title, but we can add them to the second charge, something that just doesn't exist in the first charge world. And it's a common occurrence for us. Coming back to the income multiple rule that you have, which is 6 on your prime stuff and then unlimited on the plus. You know, we've certainly placed cases, you know, or we've given the option, you know, we can add someone on. And so that's just something, as I said, just doesn't exist, which you guys do, which is really good. Yeah.
I think a lot of the other points on here I've probably already mentioned as well. So I think we'll just jump on to the next slide. Just conscious of time as well, I think.
Yeah.
So we could just jump on to the next one, please. There we go. Again, this is just to put them up on the screen so you can see a lot of the kind of reasons for second charges. We've mentioned them already, a lot of them. Obviously, the 2 most common ones there: home improvements, debt consolidation. Matrimonial settlements are there, school fees, tax bills. If you've got applicants that have got, you know, a portfolio of buy-to-lets and they're looking to take money out of their residential towards a deposit or an outright purchase, or even could be a purchase of a holiday home overseas. Those are all things that we can do. If you're looking to take money out of the property to gift to a child so they can get on the property ladder, you know, that is absolutely okay as well. Mentioned the little, you know, the blips on credit as well. So if there are, you know, if you do have applicants with a bit of adverse, the 1 year self-employment I've mentioned as well. And, you know, if there's any, you know, complex income, or if there's an awful lot of, you know, it could be benefit income combined with self-employed and a bit of employed, you know, whatever it is, we will look to take that. We will look to take that income. Have you got anything
on that note as well, Matt, on the plus plan, you've got the option of obviously using the latest year's income if self-employed, of course, coming back to the COVID and so forth, you know, where, of course, income did dip, but now has gone back to a consistent level, or a level that was achieved in prior years before COVID. You know, that plus plan caters for that. And again, we do quite a bit of business on that as well.
Yeah, and you know that you're even open to referrals at that point, you know, to even get it on the prime product as well. If you've got history of, you know, a business that's been trading 5 years, we get an accountant's reference and we can clearly see that there was a dip due to COVID, and the accountant gives us a bit of a, you know, rationale as to how they were impacted. You know, if we can clearly see that, we can ignore that year. Just simply remove it.
With the explanation, account, you know, projection even as well. I'm not saying you work off the projection solely, but yeah, as you said, if it all makes sense, then again, common sense lending, isn't it?
Yes, yeah. That projection gives us that little comfort blanket.
Yeah.
Okay, yeah. So if we can jump on, please. I almost feel bad to say, like I'm bossing you around. Next, please. Okay, so just some packaging tips. You'll see it's a blank screen. Now, really, this is where we are quite similar to first charges. I mean, really speaking, packaging is really simple for seconds. Ultimately, you're going to have an application form, you're going to have a direct debit mandate and an income and expenditure form that the applicants sign. Now, along with that, of course, if you're employed, we need 2 months pay slips. If you're self-employed, it's an SA 302 or potentially an accountant's reference. If you're doing some debt consolidation, then we may need to be provided with a settlement figure or some details about credit cards that we're settling. And that's one good thing to mention as well. When it does come to consolidation, we will always settle that debt directly. So, your applicant can feel comfortable that when that loan completes, 9 times out of 10, everyone opts for the electronic payment transfer. So when that deed comes in and the deal completes, if you've got 20 items of credit that you're consolidating, and they've all been selected to be paid via electronic payment transfer, on day of completion, bam, button is pressed, and all of those debts are settled directly, which gives people a bit of comfort knowing that.
It's one less thing for them to sort out as well, especially if they're clearing 10 items of credit, having to send them on to the lenders, the creditors, and so forth.
Yeah, absolutely. Absolutely.
To worry about, essentially, yeah.
And if the cash out isn't for consolidation, let's say that the loan is for home improvements, then we would probably have just had a breakdown of what the loan is going to be used for. If it was a large amount of money because they were doing a very large extension, of £200,000 cash out, then we may need to have plans, quotation from a builder. So really speaking, there was very, very limited. There's not much information that's required at all. Yes, there's the additional things that someone like Paul will be able to help you with the loans engine in terms of, the consents that are needed or the settlement figure for the second charge that's already that we're redeeming or valuation that's required. That's what you guys are there for, is to help.
Yeah, absolutely. Yeah, I mean, of course, there can be, and I'm sure, a lot of people on here today, maybe, completed a second, and it might have been a bit painful. Obviously, it depends if it's with pepper or not, and so forth. But there are things, as Matt said, that are required outside of your first charge. So take consent, for example. Sometimes a questionnaire might be required because the mortgage either isn't on the credit search, or there's just some discrepancy around if the payments were made, if it's showing that they were one behind and blah, blah, but the client's saying, no, that didn't happen. Okay, well, you get a reference from the provider. There are things like that which you wouldn't, necessarily come across when you're remortgaging or looking at a purchase. However, again, coming back to your portal, Matt, your system, it sort of gives you a shopping list, so to speak. Especially around the income and expenditure, where there's low figures and so forth. It tells you what they're looking for, which again, is just from a user perspective really helpful, and makes the deals go through a hell of a lot quicker than it used to, certainly.
Yes, yeah. Could we have the next slide, please? Okay, this is a really good just example, again, going back to the beginning, actually, where we were talking about the misconceptions of second charges. What this does is show you what our typical customer at Pepper is. So it's not that person that you thought would be a high LTV, because our average LTV there is 65%. It's not the people who are self-employed with not much track record, because the vast majority of our cases are employed. It's not the people with adverse credit, because as you can see, our average credit score is 450. So really, when you look at all these things, an average household income of over 72,500, and the LTV, they are prime customers for the high street. So it's just, I thought that was a really good one just to have there, to show you that it's not the old-fashioned kind of, I know the term, you don't use the term anywhere, but the subprime customer that people think that second charges are for.
I think the loan to value, I think the LTVs, because again, people assume, it's always high LTV. If you look there, 65%, and that certainly would have come down over the years, I think, because beforehand, further advances just certainly were more easy to obtain. Whereas now, you know, that if you look at that client profile, that screams, you know, prime client, doesn't it? You know?
Yeah, absolutely. And I should point out as well, I mentioned an average loan earlier, but our average loan has increased considerably since that information was pulled. So yeah, the average loan was 42, but it's closer to 60 now.
It's the same with us, yeah. SRF currently it's running around 65k.
And that's probably because and you'll be probably better positioned to answer this, is that, you know, we have seen a lot more debt consolidation recently.
Oh, yeah.
Because of, you know, rising costs, interest rates, cost of living, all of that kind of stuff really impacting people now. Everyone's residual income is just, you know, going down and down, isn't it?
Yeah, different landscape, isn't it? You know, if you roll back, okay, I was going to say a year ago, we're in September already, but if you roll back to the beginning of last year, you know, it sort of coincided with the stamp duty breaks and obviously the low rates that were available at the time. You know, people were snapping up properties as that, you know, obviously the market rose and so forth. You know, they were buying properties that just needed a bit more work. They weren't afraid to get their hands dirty, you know. So there was a vast amount of home improvement deals that were coming through. Now, however, if I was to look back at the MI for the last, you know, 7 to 14 days, you know, I would say, I'll bet money that you're probably talking 75% is debt consolidation at the moment for the obvious reasons.
Yes, yeah. And we've seen the massive uplift in the 5-year fixes because of the interest rates again. And I can see here we've got 75% on a 5-year fix. But I did look at the stats from last week when we had the stats for the previous month. And last month it was just shy of 89% of our business was on some sort of 5-year fix. So that's either with a 5-year fix with ERC or no ERC.
Yeah, because we get that a lot. You know, when an intermediary approaches us, you know, say, look, they've got 2 years left on their deal. The ERC, let's say £5 the first, doesn't make sense to remortgage them out. Can you look at a 2-year fix? And then, you know, once we take hold of it, and we'll go into that in a second, I guess. But, you know, once we take over and, you know, we provide the advice and go through it, and at the end, they're looking at the copy of the ESIS saying, why did you offer the 5-year fix? And actually, when you go into then the detail, they're quite surprised. And it's okay, that makes sense, you know. So it's not always the two, as you said, you know, 89% lands on the 5-year fix for various different reasons. But, you know, one of them certainly is certainty, isn't it? Yeah,
absolutely.
Yeah.
If we could just jump on, I think is that the next one. I think we're close to the end now. Basically how do you access our second charge products? So now I think it's always good to be open and honest and explain exactly how you can access us. So we have 3 options ultimately. Now the first option is being a direct to consumer route. So that would be, you know, if your applicant, if your customer just did a search online, they could come across, you know, our direct to consumer arm, and they could apply directly to us. Now, the rates are slightly different direct to what they are through an intermediary. They are slightly higher. But if your applicant was to do that, then you don't see anything off the back of that, because it's you know, we're given where the other department, us as Pepper, are given the advice, and you know, you wouldn't see anything off the back of that. The second route is that, yes, we do have a route in direct to us. However, if you were to come direct to us, I would, you know, when we're going through the fact find, the key things we're looking at is, do you regularly transact in second charges? You know, so are you regularly seeing seconds every month? Do you have a panel of lenders so that we can be satisfied that you are giving the best advice and that, you know, you're giving the best route to the applicant? So really speaking, if you only see the odd second charge every now and then, a route into us wouldn't necessarily be an option. And then the third route, then you have through a special distributor or a packager, master broker, like the Loans Engine. And the one, you know, Paul, I'll let you speak, but you know, for us, we know that you're going to someone who has a full panel of second charge lenders. We know that if the deal is coming to us, then that is the best route, the best outcome for that applicant.
Absolutely. You know, where we are whole of market, we genuinely use the panel. I mean, of course, we run a lot of business with Pepper for obvious reasons in terms of, you know, just pricing and products that they have, and, you know, the ease and speed, as we call it. But yeah, you hand on heart, we can honestly say that, you know, we have selected Pepper, for example, for, you know, the cheapest outcome, not just on face value for the client, but again, coming back to what we talked about earlier, it's all about the future plans. It's all about it's sort of the second bite of the cherry for you guys, the intermediaries, is, you know, remortgaging them out. We want to make sure that, you know, they're not, you know, penalised in, let's say, 2 years' time because there's an ERC, because they didn't understand the product necessarily, you know. And so for us, we have an audit trail of products that were available at the time as to why we selected that product. Now, it could be, you know, some clients, so for example, take Pepper, where evaluation isn't required. They need the money fast, you know, they have to pay a bill or whatever it may be. It could be that actually we've chosen a product that is slightly more expensive than the next lender, but there's a rationale behind it. And that's what we do. You know, we take control, obviously, you know, we provide the advice. And also, I think maybe something we sort of touch on, Matt, is, you know, in terms of remuneration as well, you know,
yeah,
in terms of what we pay the intermediary, is virtually the same as if they were to come direct. And so, you know, for us, it's taking it off your hands and you getting back to your core business. And ultimately, the end result is the same in terms of what goes into the bank account, really, is where we get to.
And don't forget, you know, ultimately, you know, seconds, if you as an advisor, you're not considering seconds, and that applicant, you've just done a PT for them and they're locked away for 5 years, you know, they still have needs. And if they, you know, if they end up, you know, in a couple of years' time with a little bit too much debt outstanding, and they could be struggling, or they need to, you know, they've had another child and they're looking to extend the property, you know, they will still have those needs. And if you're not offering the seconds, you know, somebody else will. And if they go online, they'll just, you know, they'll end up somewhere else and you won't get anything off the back of it. Or they could even end up going direct again. And, you know, if you're offering them yourself via someone like, you know, the loans engine, you are still getting something for that applicant. Yeah,
absolutely. It's, again, that old saying, you know, if you're not doing it, someone else will.
Yes.
And it's not just someone else will. They'll also take away the, you know, the future, you know, the future opportunities, whether it is the remortgage, you know, because the reality is, you know, as a human, we don't like rejection. We don't like being told no. And so, you know, if you look at options, and no matter how tricky you think the case is, you know, take adverse as an example. You know, adverse for the high street is not adverse for a second charge lender in most cases. And so, you know, if you were to return to the client and say, look, I just can't help, the client's just going to go online, aren't they? You know, it's just human nature to want to rebel and say, well, look, if they said, surely there's something out there for me, they'll just type in debt consolidation or home improvement loan online. They'll get into the hands of the aggregators. You know, I'm not going to name any brands, but they're all over the plus, all over the TV and radio. And what will happen is they'll market them. Again, they'll take away the protection and all that sort of stuff that you guys do really well. And that's the danger. You know, someone else will do it if you're not doing it.
Perfect. Can we just jump on to the next slide? I think that's the last one. And yeah, again, we probably already we've already summarised a lot of these things.
I think we've just read it before it's popped up. Really, the last line: "If you're not offering, someone else will." There it goes to show, isn't it?
Yes, yeah, absolutely. So, you know, obviously there's loads of opportunities with second charges, and just as a reminder to everybody, you know, it is a it's a regulated product, regulated mortgage product, exactly the same as a first charge. The packaging is extremely straightforward, and if speed is of the essence, as I've mentioned, you know, you can get things through particularly fast, especially with Pepper Money. So yeah, it should really form part of your process, and should take pride of place, I think, in the products that you offer, because and as I like to say, of course, I've already said it, but if you're not offering the second charges, that somebody else will. Yeah. But that's so that's it. Thanks very much all for listening.
Thanks a lot, guys, and hopefully you have some questions. Yeah, you can pop over in the chat. I'm more than happy to answer.
Thank you very much. Thank you, Caroline, Matthew, and Paul, for your presentation. And we do have some questions. We have about 5 minutes to answer them, so I'll get to them. I'll start off with a bit of a 2-in-1 question. So first, we've got Leo de Silva asking to clarify whether you said you don't need consent from the first child provider to get a second charge mortgage. And then Dan Scott follows that up with, if you do need consent, how do you go about getting that quickly?
Do you want to answer that, Paul?
Yeah, so what was the first question? Sorry, Stina.
So the first one was just a clarification of whether you need consent from the first child provider.
Yeah. So that, you know, if you have access to land registry, you've just broken down into your A, B, C register. On the B register, it will actually show you if there's a restriction or not. But if you take probably the more regular high street providers that we see, so for example, Halifax, you don't require require consent. You know, there's Barclays, typically you do, Santander you do. So the big names like NatWest, more likely you do. And then if you do need consent, then quite simply, you just need to put a request into them, asking for consent to register a second charge in favour of, for example, Pepper Money. The exact wording obviously is on their website. And there is a fee typically for it, but that's usually no more than £100, and typically comes back within 5 to 7 days, sometimes sooner. You can again, if it's free, you can. We use, believe it or not, we still sometimes use fax in the second charge industry, but you know, obviously you can access email and you can just ping it over to them. But that's easily obtainable.
Okay, and just quickly, how do you check whether you do need consent? How it differs from each lender?
Yeah. So again, that would be shown on the electronic title deeds of the property, which is again accessed by a land registry. It's it's a simple, easy tool to use.
Of course, thank you. And we do have a bit of a case study from Rebecca Fielding, asking, I guess, more to Pepper. I'm guessing, would you be able to help a customer who has a mortgage on a leasehold flat that has been undervalued and needs the lease extending, which is now under 55 years, and they want to clear a debt of 40,000 built up by school fees, but NatWest won't help. So, Caroline, Matthew, what would you do in that circumstance?
So yes, we can look at loans.
So I think we've lost Matthew there.
Oh.
If Caroline could just carry on, please, if that's okay.
Yes, of course. Oh, hang on a minute. I'm losing you now. Hang on a minute. So the question, sorry, just to kind of refresh it, is if you've got an undervalued property and the lease is running out.
Yeah.
So I would suggest that we would be able to look at it, but it would depend on the consent of NatWest. I think this question is going to have to be a Matthew one, unfortunately.
Okay.
Unless Paul, can you answer that one?
Yeah, so NatWest will grant consent. So first of all, irrespective of which lender you're going to, NatWest will grant consent, because for them, as long as they're not in arrears, then they will absolutely be fine with that. Was the question, part of the question, to extend the lease? Sorry, was it Shakina? Or?
Yeah. Oh, you're saying it was undervalued because it needs the lease extending. Yeah.
Yeah. So second charge lenders typically, if the purpose of the loan is to extend the lease, then they will typically work off the future val to the post extension valuation. So that is something that we can do.
Can you hear me?
Yes, we can hear you.
Good. Sorry, I knocked the Ethernet cable when I moved my laptop back. Really sorry. So yes, yeah.
Also, big back in that.
We can do that if we and very often there will be solicitors involved with things like that. If they are acting on the client's behalf to extend the lease, then funds are going to the solicitor. We have an undertaking from the solicitor then that says, on receipt of cleared funds, we will look to extend the lease by X amount of years, so that we know that then that is going to happen on completion.
Of course, thank you. I think we have time for maybe a couple more. So the next one would be, is there a possibility, we've seen that the market is growing and it probably will continue to do so, is there a possibility for second charges to become as common as remortgages or further advances?
Well, it's something that we've been certainly fighting for some time. Yes, we've been doing a lot of workshops like this and road shows, round tables to really kind of bring second charges to the forefront of advisors' minds to really consider us. And absolutely, why? Of course, I'm going to say yes. Why not? Because I work in second charges, and prior to working in seconds, I brokered in seconds. So yes, I think as long as everybody realizes when they should be used, why they should be used, and that they are a really good alternative to a further advance or remortgage, then yeah, it's all about it's education ultimately, and that falls down to not just us as Pepper, people like Paul and the work he does, and all other second charge lenders as well.
Yeah, no, I do agree with you.
It will be a byproduct. Yeah, it'll be a byproduct of again, tightening belts on the high street. Seconds will just come into play a hell of a lot more, and then people will then start to realise how eager they are to place and actually then be to complete.
But also from a consumer duty perspective as well, you know, exactly. I do think seconds has a choice, should be part of an advisor's toolkit. It is just about providing as much choice as possible for consumers. So yes, in the ideal world, it would be a good thing to be on par with a further advance or a remortgage. But at the end of the day, it is about providing the best customer outcome. And I do think, given the recent turmoil in the macro economic environment, I do think that you'll see a lot more consumers who will fall into a second charge, and it's about being able to then facilitate it, which is obviously why we're trying to raise as much awareness as we can.
Thank you very much. And that is all we have time for. So thank you all for coming and join us today. And I hope everyone watching found it educational and learned something from this. Any questions that weren't able to be answered, the team will get back to you. They have your details and they will get back to you directly on that. So thank you all for your time today, and hope everyone watching has a good rest of the day. Take care all.
Thank you.
Thank you.
Thank you.